Do you have a CFS? Do you have a COVID financial strategy? In this episode, we're going to cover how if you have money in retirement accounts and you may be not thinking about it, you may even think your IRA and 401k are going to be tax-free in your old age. Many people do. But in fact, that money is going to be taxed as regular income. And if you have success, it could be higher taxes than you pay today. Learn how we can take money you have in retirement plans to make it tax-free for the rest of your life only in 2020 due to the CARES Act and the COVID-related distributions. Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I'm joined by one of my closest friends, a man that has helped grow Sound Financial Group and the man that I would trust my family's finances to if anything ever happened to me and where I would tell my wife to go, Cory Shepherd. Now, I get a little...
We're supposed to be starting this episode, not starting me crying. Like I'm gonna need a minute. I'm gonna need a minute after that.
Well, I think sometimes I joke with you so much at the beginning of these episodes. I figure every now and then I need to slip a little authenticity and appreciation in there so that our audience doesn't think I'm a cyborg and they get a chance to know how important you are both to me and all of our clients, because, you know, that same way. That's why Cory and I have the company set up the way that we do, so that if something were to happen to either one of us, nothing, by the way, I didn't get diagnosed with something. That is not the reason I'm talking about this.
Like, wait, Paul, this is not the time to tell me this news.
No, just this kind of overwhelming amount of appreciation for the way we built the company, the way we have our household financial officers that work with each client and create that opportunity to have some institutional memory. So if something happened to your advisor with our firm, there's somebody else with the same philosophy, access to the same institutional memory we have here at Sound Financial Group to make sure they're cared for. And my family, Cory's family, we also benefit from that as clients of Sound Financial Group. So just really appreciate you, Cory. Now, kicking off today, we're going to talk a little bit about the news, and then we're going to talk about how we can use the CARES Act and COVID to make some tax moves that are simply not going to be available at the end of this tax year. But Cory, do you want to tell them what's in the news and what we're going to talk about today?
Yeah, the New York Times article that you probably remember from last week about how much tax Trump did or didn't pay on his tax return in the last few years. And it's getting out there and creating a lot of stir.
Sure. And the way we're going to approach and we want to talk about is not the way you might expect.
Yep.
Think about this for a moment. And you're about to see it in a lot of campaign ads, etc. The media has covered it mainstream across the board. And the overwhelming kind of zeitgeist or the prevailing narratives about this are that wealthy person didn't pay enough in tax. And what we want to do, and especially the theme of our episode today, is that was just released last week. You've now seen a week of these ads coming at you, a week of these narratives in the media. And what they all revolve around is that the wealthy are not paying enough in tax. And it's coming from all sides. Conservative media is like, well, what about all these other people that didn't pay enough in tax? And the more left-leaning media is saying, you know, President Trump should have paid more in tax. But backing off of that, what we want our business owner clients to know and our high income earning executives is that it's now getting heavy in the zeitgeist that those of us who have accumulated wealth, those of us that have high levels of income, are going to be taxed more heavily.
And remember, depending on which politician you're talking to, wealthy and should pay more tax could be an income as low as $100,000 a year of family income. So that's a really important context. If you don't think that you're actually, many of you are more lumped into the same group as Trump than you would think.
Indeed. And let's just talk about where tax brackets have been in the past as it relates to this conversation of the wealthy are not paying enough. Now, we have record stimulus that's just gone into the economy. That adds to the debt and deficit. We still have
security is, yeah.
And Social Security, Medicare, Medicaid only have to be projected 10 years. So we're not getting the lifetime of those current promises and present value as a part of the deficit yet, like at all. That's only a 10-year projection in those deficits. So here's a history of the U.S. income tax rates. And what you can see is that income tax rates have both been very, very high and often come as a result of the federal government being reactive. You can see that in World War I, we had taxes over 70%. You can see again in the 1950s, taxes were over 90% on the wealthiest Americans. Now, you had to make a little over $400,000 to pay that much in tax, but in today's dollars, that's like $2.5 million. That is not at a wildly outrageous level of income. I mean, it's a great income, but how many people have that income year because they sold a piece of real estate or because they just had an outrageous amount of business that year or they sold their business that year? Those are the things that we have to be cautious about. And if you look at this versus the average, and if we look at the average top tax rate over this period of time, it's 57.3%. So even when it comes to the average top tax rate, we are lower today than we have been in quite some time. And so today our theme is going to be how do we take and pay known taxes today, put that control back in our clients' lives, and leave money growing tax-free for the future. It's the importance of us being aware of taxation and shifting as much as we can to tax-free dollars, because this public narrative, this zeitgeist that's out there, that those of you who are wealthy are going to have to pay more tax. And some people are even saying you are wealthy simply because of the amount of assets you have, not even having to do with the amount of income those assets generate. And that's something we have to be cautious about. So when you see all this stuff around President Trump's tax returns, when you see the conversation around all these companies should pay more tax, know that it's the zeitgeist that more tax is what we're being made more comfortable with. And like slowly boiled frogs, we often take that and we don't notice it. So we want to make the moves we can today to assure our future in the most fairly taxed way possible. Anything else you'd add to that, Cory, before we get to the strategy today?
That's so great. I'm so excited about this strategy. We've been working on it for several months to be able to share this with everyone, and I haven't heard much anything about it anywhere else. So
and by much anything, we mean we haven't heard anybody talk about it. And when we're done, we'll talk about why big box financial retail doesn't bring this to the fore. We'll leave that off the table for now, but Cory's going to remind us to come back to that so we can be in a position to give some context about why this is not in the mainstream financial media yet. So what we're going to talk about is this idea of being able to use the most recent CARES Act, and that created the stimulus, but also created some other very limited time tax rules that we can take advantage of exclusively in 2020. And one of those things that came out of the CARES Act was the ability for individuals to take money out of a 401k or an IRA up to $100,000 per spouse with no penalty. Now, that's just the beginning of the story, and they're going to give us 3 years to put that money back in. Now, let me go to my graphic here briefly just to show you what this looks like from a money flow perspective and where I want you to focus if you're looking at the screen right now, or if you've used the download link to be able to get this graphic. What I want to call your attention to first is just the left-hand side of the screen. And what you're going to see is that we have $100,000 that can come out of a qualified plan. That's 401k or IRA. And then you get this unique opportunity that you have no penalty. If you're under age 59 and a half, normally you'd have a 10% penalty. Now we have no penalty, and we do not have to recognize the income all in the first year. We can actually recognize the additional income 1/3, 1/3, 1/3. Now, we have not seen a piece of tax legislation like this waiving penalties from retirement plan distributions since maybe the advent of the Roth account, when they gave us the ability to convert an IRA to the Roth as long as we paid the taxes over the next 4 tax years. That's the closest thing I've seen in my about 23 years of doing this. Now you can pay or recognize the income faster if you chose, but at a minimum, it has to occur a third. Okay.
So
Anything else about that? Yeah.
just right there, what I love is this is not for the Roth strategy, which we're going to talk about next. But if you have some other good uses to put that money to, you get to use the IRS's money for some period of time, for 2 or 3 years, before you have to pay it to them. So
And
no 10% penalty, and you get to use the IRS's money to your advantage. It's a really cool opportunity.
And Lord knows there's enough time that we've overpaid the IRS. It's about time that they got to use our money for free over the year. It's about time we got a chance to use their money a little bit over the next few years. Now, to Cory's point, people can use just the left-hand side of the screen to get different things done. We've got some clients that are near retirement and said, hey, I'd like to just be mortgage-free. As you guys know, we advocate it's a great idea to have a house paid off. It's just dangerous to do it slowly over time. But if what you could do is you're within spitting distance of paying off that mortgage, you might be able to use a technique like this to do it. You might be able to use it to take an opportunity, invest back in your business, buy a struggling business. So we're going to talk in a moment about how we can use this for a significant conversion to Roth, but just know you can use the left-hand side of the screen to get many things done, but we need to talk about what qualifies you to do this. So the first 2 qualifications are really easy. That is, you were positive for COVID. Regardless of illness or hospitalization, just you had a positive COVID test. It's the first time you ever thought you'd have to attach test results to your tax return. But you better keep that in your records.
That you need to,
just put it in your tax records box at home, right? Then you have anybody in your household who got COVID. And the third one is where we've got a lot more liberality, which is something to the effect of if you had significant revenue reduction, career impact, furloughs, layoffs, time out of work, all those things. If those things affected you, you qualify. Now, under that blanket, nearly everybody will qualify unless perhaps you're a government employee. And if you are a government employee, we're happy to help you walk through it, see if you could qualify. But in the thrift savings plan for some of the, kind of well-weathered government employees, kind of at the top of their game, getting ready to retire that we've talked to, the TSP folks for the thrift savings plan are actively saying, hey, you might not want to do it. So with that kind of caveat, and you guys can go to the download page and grab this in the link that's in the description of this video or the podcast, and you'll be able to see those rules right out in front of you.
Now, can I give 2 quick examples? Because folks are probably asking, wait, is this me? The first one would be if you made X amount of money last year and you're pretty clearly on path to make less than that. That would be one real clear example. But I would also try on if you thought you were on track to have grown your business this year and you didn't, and you're about the same, then that would also be one that I would say you could put forward as this is why I qualify.
Layoffs at your company, and you said, well, before the end of 2020, I don't know what 2021 is going to look like. I want to have that cash on our balance sheet, not inside the 401k. The odds, I think, and from professional counsel we've sought, of this ever being audited are about 0 because so much of this is going on for all the right reasons. But we would encourage you to make sure you're following within the lines of the law. Because we want to make sure that as you use these techniques, we're using the most conservative interpretation of the current tax rules to be able to execute this decision. So now we don't need the money. We're not going to pay something off. We're not going to do anything like that. What we're going to do is this unique Roth conversion. So before we go back to the sheet, let me just explain why this normally doesn't work. If you're, say, 55 years old, you have $100,000 in an IRA, and you wanted to convert it, what you would need to do to have the conversion make mathematical sense is you would need to convert it, and then you'd have to find the tax due, say at a 32% tax rate, you'd have to find $32,000 in another pot of money to be able to do the conversion. And that's fine. That's how it's done every other year. What doesn't work in every other year is if you took the $100,000 out of the retirement plan and then tried to put it back in a Roth, you would have to pay penalties on all the money you didn't put back in the Roth. So if you wanted to take and put $70,000 of your $100,000 into a Roth, now the $30,000 you didn't put back in the plan is going to have a 10% penalty on it. And that's the other part that's waived as a result of this portion of the CARES Act. So let's talk about what can be done instead. And that's going to take us to the right-hand side of our one-page sheet on this strategy. That is, we take the $100,000 out and it's now in a non-qualified account. Non-qualified just means it's in your name or yours and your spouse's name. It's not inside a retirement account anymore. So you call up your 401k, say I want to take a CARES Act COVID-related distribution. They send you the $100,000 check and you go put it in your bank. That's step one.
Yep.
Now, step two is that what you can do. Now, remember, what would happen just from right there is your income recognition, not the tax, but each year you're going to recognize $33,333.33 every year for the next 3 years. But this is where we're going to take a departure from that strategy of just leaving the money on your balance sheet. You see, we're going to take $70,000 and put it right back into an IRA. Now, we'll want to make sure that that gets academically allocated, globally diversified to put you in the position that that money has the best chance to grow over time. That $70,000 that goes to the IRA gets converted to Roth. So what does that trigger? Remember, a moment ago, we had $100,000 of recognition falling under this 3-year rule. The second we rolled the $70,000 into an IRA, it wiped out $70,000 of that $100,000 of taxable income recognition you had to take.
So
Then
we're pushing that back into this tax year. We are
when we
choosing to
convert to
recognize
Roth.
a lot more income this year.
Yep. When we convert that to Roth, that's the next step. So we erased the tax liability, and then converting to Roth puts it back in the current year. So as you can see on the bottom there, that would make your 2020 income recognition a total of $80,000. Now that total of $80,000, that's shocks and scares a bunch of people. Say, oh my gosh, $80,000 extra I have to take in income recognition. Well, at a 32% tax rate, as you can see, is about $25,600. Now, why $80,000? It's because we have to take the $70,000 recognition this year, and we still have $30,000 left over from that initial distribution. So that now gets spread out $10,000 in 2020, $10,000 in 2021, $10,000 in 2022 of income recognition. So that first year, we have $25,000 in taxes that we have to pay. Now, quick sidebar here. That money that we have to pay, you already have to pay in your IRA and 401k. A lot of people get messed up about this because it feels like, oh my gosh, Paul, I'm paying more in taxes. No, that's the tax deferral that you had from earlier years. Because when we put money into an IRA or 401k in a before tax manner, you are delaying the tax and you're delaying the calculation of the tax. So what we're choosing to do is say, let's pay some tax on the seed so we can have a tax-free harvest later, which is what we can do with the Roth. Then in 2021, we have to recognize another $10,000 of income. But in 2021, about April, when you get your taxes done, it's going to be this $25,000 tax bill. How do we pay that? We set aside the $30,000. The $30,000 that was already owed eventually inside of an IRA. It puts us in the position that we're just going to recognize that future tax liability that is in our account today. When you get a statement that says you have $100,000 in a qualified plan, you do not. You have a partnership with the IRS, and the IRS requires they be paid before you take out the money. So,
and this comes back to why big box financial retail doesn't talk about this strategy. They also don't ever reflect on your statement. Here's the future liability that you have to pay the IRS. It all says Cory's 401k with all that money looking like it's mine. So I have a nice rosy feeling about it, but they're actually getting to manage my money right alongside the IRS's money and charging everybody fees for it the entire time.
You bet. So now 2021, we have plenty to pay our tax bill. So the only thing that's out of pocket is part of the income recognition for 2021 and 2022. But what we were just able to do is take a $100,000 that was going to be taxed at regular income on for sure later. And what we're able to do is say at a time where we at least understand what our tax rates are, before tax rates start rising more and more and more. And I have to say that as somebody who follows politics very, very closely, this is the first set of presidential debates I have ever watched in my adult life where every single person who was on the debate stage, all of them, without exception, said, your taxes are going up. That is part of this zeitgeist that I'm talking about, that what we want to do is make sure we control as much of our taxation as we can. So we have 2 more years of that income recognition at a relatively low cost. And if you had a lower income tax year in any year, you could move some of that forward and pay it all at once. Here's the last part of this. Going back to the left side of this graphic, remember it's 3 years to get the money back in? Well, we left the $30,000 on the sideline so that we could convert the $70,000. Remember, the beauty of this is we're using the money that's already the IRS's, that's inside your 401k. The amount that you already owe them is what we're using to pay this tax. You're not taking an extra $25,000 sitting on the sidelines paying us. We're creating that sideline money to pay this through this distribution via the CARES Act COVID-related distribution. But that $30,000 can still get back into an IRA. So let me just walk you through this, that if you took that distribution today, which I do not recommend doing solo, like reach out to us if you don't have a coach or an advisor that understands this, which I don't know any that currently understand. I believe they're out there. You guys have heard me before. It's like baby pigeons. I believe they exist. I just haven't seen one. Yeah. Somebody out there has got to understand this. Unfortunately, every CPA we've run it by and our counselor are like, this is absolutely the most conservative interpretation. You guys are dead on with this. But we can get that extra $30,000 back in because we have the 3-year timeline. So picture yourself in 2022. You've had a good couple of years. It was shaky there for a minute in 2020. And now here you are and cash flow is fine. Your savings is doing great. You're investing money. We can actually put the $30,000 back in. And because we've already paid most all of these taxes other than that last year of recognition, which by the way, we planned on paying anyhow, we can actually easily take the last $30,000, put it in an IRA, which if you just stop there, you'd actually get some tax credit for the $30,000 of recognition, but that's not what we would suggest. Since you already paid the taxes, we just immediately convert that IRA to Roth as well. And when this is all done, nice and neatly, we've moved $100,000 from the pre-tax environment to be taxed at a later date that the IRS gets to choose what the rate is going to be, or Congress, but somebody we don't have direct control over. And we get the opportunity to shift the other $30,000 back in later and not have to make the full decision from day one. Now, for those of you whose portfolios have been punished this year, and maybe due to poor investor behavior or bad advice, your portfolio has not rebounded like it should have. This is also an opportunity because we're getting a chance to do this conversion while the markets may be lower, giving you a better chance to be able to get the money into Roth, getting it properly invested, and then have that money blossom as time goes on. Now, to Cory's point about why big box financial retail doesn't do this, it's very simple. If you had a business where you could increase your revenue by well over 30% simply by getting a piece of legislation passed, wouldn't you? You see, that's why 401ks are constantly being lobbied to get more and more money put into them. Each time it happens, they get to manage your money and the IRS's money. So whether you're talking about the Edward Jones, Morgan Stanley, Northern Trust, UBS, Merrill Lynch Private Client Group, we can keep going down the list. All of these companies are not going to tell every single one of their advisors how to do a strategy like this. And the math is obvious. This is a fair amount of paperwork for our team when we engage in this with our clients, and we don't mind. Right. But every time we do it, we're actually managing 30% less money. 30% less money. No wonder you don't see this advertised when you're surfing financial websites, and everything from annuities to term life insurance to you should be doing more money in this great mutual fund because look at its returns. All those things you get hit with in banner ads and little pixels that follow you around the internet. All of that is not communicating to you what you could do to get yourself in a tax-free stance. Because these institutions look at it as you getting a chance that A, your money is not as sticky because now it's tax-free and you could take it out. And two, they're managing less money because you now have the money inside a tax-free account. They're no longer managing the IRS's portion of your money. Now, today we didn't drop a Sound Financial Group commercial in. Here's my encouragement. If you've been listening to these podcasts, if you've been watching the YouTube and you're like, gosh, I think maybe I really need some help, I want you to know Cory and I would crawl through a mile of broken glass to share our philosophy with you. Now, I don't know you, but I know who people are that we get a chance to just share our general philosophy with. And people walk away going, that was amazing. If they were introduced to us by an existing client, a thank you goes to those people and says, thank you for introducing me. They might want to apply to become a client. They might not want to, but that first conversation, we don't get in your personal stuff. We don't ask you to open your financial kimono. We just try to share enough philosophy with you, giving you some insight to the way the financial institutions think about you and your money so that you can make better decisions for the long run. And Cory,
so if you would have a question about this strategy and if it might fit you, we have a link to set up a 15-minute conversation with someone on our team. I'd highly encourage you to click that link because it'd be a lot easier on us than making us crawl through that broken glass like Paul said. Just a lot easier on everybody, and we can have a quick chat to see if this is something that would apply to you, and then we can find time to talk more later if that would be helpful to you as well.
And that's it. We just want you to know this. We want you to share this on social media so that the people you care about know. People are not talking about this. You now know why they're not talking about this. And this is limited. Like, please, if you don't hear this until December 15th, please call us. We may still be able to help you get something done before year end. But if you're hearing it now, don't wait until December 15th. Don't delay this. If you're listening to this late at night, you're on a run, put it in your calendar to call us tomorrow. Put in your calendar to get on that link and schedule. That's what's going to make the difference for you. So often we sit back and we have well-intentioned thoughts about the future, but we don't connect it to the pragmatic action we need to take to produce the future that's important to us. And so we hope, from Cory, from myself, from all the team here at Sound Financial Group, we hope that this gives you some insight as to how maybe taxes can be managed differently, how we can have strategy around it, and how working together we can help you design and build a good life. Hey guys, so glad you could tune in and watch that video. I want to remind you to subscribe, be sure to hit the notification bell so you can get the latest piece of financial knowledge we release. And don't forget, go to Amazon, get a copy of Sound Financial Advice. Why? Because it'll make you better looking and smarter.